The bond market warns we are about to repeat the 2001 dot-com bubble crash right now. Not many investors know about it. Michael Burry has been busy lately. He just warned us that Salesforce stock CRM should have been down 25% on the 10% of staff job cuts. He added job cuts are so not the reason to own that. CRM was down 3% during the day. The meme stock Bed Bath & Beyond was the one actually down 25. Warns it may go out of business. Salesforce is still a $135 billion company today. It was the world's largest cloud-based enterprise software company in Silicon Valley last year. But the stock has been traded around its 52-week lows. Burry's tweet did pull down other cloud-based enterprise companies, like Warren Buffett's Snowflake down 7%. If Salesforce crashes another 25% like Burry says it should, that means the market will crash another 25% too, based on the one beta score of the stock. Why I think the bond market is telling us the Fed will cut rates in later this year, when the market tumbles another 25%. Why is TLT sneaking its way up? I will explain it all right after this. And of course, smash the like button. If you want to be my good boy, apply to write your first book with me. Welcome back to the Audacious Money Witch channel, where we talk about macroeconomy, stocks, bonds, and commodity markets. If you like any of these topics, you are intelligent. That's why you're here, and you know what to do. And push my button if you like what you see in today's video, because I can't push it from this side. This video is brought to you by my Patreon. If you are a good boy, go to patreon.com/magicalgoddesscheryl to add more meaning into your life. If you play your cards right and completely submit like my good boys do, then I will take you under my wing. Author of best-selling books, Goddess Cheryl. My good boys always get rewarded handsomely. You are such a good boy. You like hearing that, don't you? You want to get into the bookstore. You want it to be real. You want it to be true. You need to be my client, don't you? U.S. stocks fell on Thursday after a hot ADP jobs report reinforced the Federal Reserve's hawkish view that it needs to continue with interest rate hikes in 2023. The report showed 235,000 jobs were added in December, well ahead of estimates for an increase of just 153,000. Meanwhile, the Fed is expected to hike interest rates by 25 basis points at its upcoming February meeting, and hike rates by a total of 75 basis points in 2023. That would put the effective federal funds rate above 5%. The Fed is concerned that the markets do not understand it means business. Many participants highlighted that the committee needed to continue to balance two risks. One risk was that an insufficiently restrictive monetary policy could cause inflation to remain above the 2% target for longer than anticipated, leading to an unanchored inflation expectations and eroding the purchasing power of households, especially for those already facing difficulty making ends meet. The other risk was that the lagged cumulative effect of policy tightening could end up being more tighter than is necessary to bring down inflation to 2% and lead to an unnecessary reduction in economic activity, potentially placing the largest burdens on the most vulnerable groups of the population. A couple of participants, however, commented that excess savings, particularly among low-income households, appeared to be lower and declining more rapidly than previously thought, or that the savings, the majority of which appeared to be held by higher income households, might continue to be largely unspent. Gotta love this stat. 106 million people aged 16 and over are not employed, but only 6 million of them are unemployed. There are 22.7 million people of retirement age who are still working at an increasing rate over time. These people will retire. Replaced by whom? At what levels of productivity? By the end of the decade, nearly all of this group will be retired. Who will support this group and increasing Medicare needs given the percentage of full-time workers keeps dropping? Millions are retiring, but millions of others are taking second part-time jobs to make ends meet. So yes, we can be adding part-time jobs while employment is stagnant. The Fed's message is clear. Check out their dot plot. They are begging for a deep recession coming this year to save their street credit. The Fed is concerned over wage growth and persistent inflation more so than recession, stretched budgets, and the fact that housing and manufacturing that have both collapsed. Of course, the big techs are helping the Fed cutting jobs, creating a recession. Tech turmoil increases with still more layoff announcements from Amazon, Salesforce, and Vimeo. Between the reductions we made in November and the ones we're sharing today, we plan to eliminate just over 18,000 roles. Several teams are impacted. However, the majority of role eliminations are in our Amazon stores and organizations. We typically wait to communicate about these outcomes until we can speak with the people who are directly impacted. However, because one of our teammates leaked this information externally, we decided it was better to share this news earlier so you can hear the details directly from me, said CEO of Amazon. The Wall Street Journal reports the layoffs are concentrated in the company's corporate ranks. Salesforce Incorporated is laying off 10% of its workforce and reducing its office space in certain markets, extending a brutal period for tech job cuts into the new year. Salesforce co-chief executive Mark Benioff said that the cuts come as many of the company's customers are taking a more cautious approach to spending, a trend that a growing number of software companies said they have been facing lately. The environment remains challenging, and our customers are taking a more measured approach to their purchasing decisions, Mr. Benioff said in a letter to employees. TechCrunch reports Vimeo rings in the new year with another round of layoffs, affecting 11% of its workforce. Since the July layoffs, Vimeo has seen a further deterioration in economic conditions in the form of prolonged geopolitical conflict, rising interest rates, and global recession fears, CEO said. In November, the company reported its third quarter earnings. showing a loss of about 100,000 subscribers from the previous quarter and an operating loss of $22.9 million. Everything is going down. A hedge fund manager who returned 163% in 2022 says stock market pain is only beginning. The reason why I started the fund was that central bank flows were going to change 180 degrees. The key difference would be a headwind on all asset prices, he told Bloomberg. One had to believe that the prices we saw were, to use the academic term, wackadoodle. He told Bloomberg he's shorting stocks and bonds with futures contracts, targeting assets he believes have been skewed by easy money policies. The $19 trillion of sovereign debt trading at negative yields, the SPAC boom, the crypto boom, private equity valuations, and public equity valuations. They're all stripes of the same zebra. He explained, the zebra being the ocean of liquidity. First in response to the great financial crisis and then to 2020 lockdown. He anticipates maintaining his short positions for years and predicted pain in the stock market won't become evident until markets go sideways for months. Big picture, everything is going down, Berger said. Price action is ultimately the Bible. In my opinion, again, not trading advice. The bond market already sees this recession coming because the Fed will make sure it comes. So will the big techs. Look at the most inverted yield curve ever in 20 years. It looks like 2001, before the dot-com market had its waterfall crash. I think we are going to go sideways till a point of no return. Then we will crash. That's why TLT is sneaking its way up. And this is my client Teddy Eazzy's book, Wicked Pussy Perfume. It is an erotic novel, such an amazing book. And this is the collaboration book with all of my amazing clients. The book is called It's Already Yours, Adversity Equals Success. Another awesome book. You are such a good boy for watching my video right till the end. Bye.